Welcome back to The Explainer. So in our last lesson, we walked through every single significant accounting policy requirement. But today, we're shifting gears. We are diving into ASC 235, and we're going to focus on the absolute essential filter for financial disclosures: materiality and the disclosure of estimates and judgments.
Here is our roadmap for today. 1. Context and the filter. 2. Quantitative versus qualitative materiality. 3. The aggregation trap. And 4. High-stakes estimates. Let's jump right in.
Section 1. Context and the filter.
When you really look at a company's financial records, the sheer volume of daily transactions is honestly staggering, which leads to a massive practical question. Do we need a separate note for every single transaction and balance? I mean, could you imagine? If we did that, we'd be handing people financial reports that are literally thousands of pages long. Obviously, we can't do that. So we need a reliable tool to figure out what actually deserves precious real estate in the notes.
Enter our ultimate filter, materiality. By definition, information is material if leaving it out or messing it up could influence the decisions of a reasonable user of the financial statements. It is all about that user. Notice what is noticeably absent here? There's no strict universal dollar amount rule. Materiality relies heavily on professional judgment. You constantly have to ask yourself, if I leave this out, will it fundamentally change how an investor views this company?
Section 2. Quantitative versus qualitative.
Actually measuring this materiality in the real world means you have to look through two completely different lenses. On the quantitative side, you have your standard math benchmarks, things like 5% of pre-tax income, or 0.5% of total assets, or 1% of net revenue. But listen, those are just starting points. You always have to weigh that math against the qualitative lens. And qualitative rules dictate that certain items are always material, absolutely regardless of their size.
These specific qualitative factors demand disclosure no matter how small the dollar amount is. We're talking about illegal acts, fraud, related party transactions with key management, covenant violations, and going concern indicators. Think about it. Let's say an executive commits a $500 fraud. Mathematically, that's pocket change to a billion-dollar company. But qualitatively, oh, it's huge. It speaks directly to the integrity of management. You absolutely cannot filter these things out.
Moving on to Section 3, the aggregation trap.
So, now that we know what to disclose, how exactly do we group it? Because there is a massive trap hiding right here. Imagine you have a few individually immaterial items. Can you just lump a debt covenant risk together with a warranty liability to save space and, clean up the document? I mean, it sounds like a neat little housekeeping trick, right?
The answer is a hard no. Qualitatively different items must not be aggregated together. A debt covenant risk is fundamentally completely different from a warranty liability. Why are the rules so incredibly strict on this? Because hiding an important disclosure in some aggregated generic bucket where users can't easily find it is literally just as misleading as omitting it entirely. And the consequences here are very real. The SEC has actually cited enforcement positions against entities that intentionally buried material disclosures in generic notes just to reduce visibility. Prominent matters require prominent placement. If you try to sweep something sensitive under the rug in a miscellaneous risks note, it will attract SEC enforcement. Transparency is the whole point of the game, not just ticking a compliance box.
Section 4. High-stakes estimates.
Now let's zoom way in on the absolute most sensitive, high-risk areas of the financials. Under ASC 275 and ASC 235, there is a strict requirement for the disclosure of areas where management used significant estimates that can materially change. Analysts and auditors zero in on these areas because, well, they aren't hard historical facts. They're educated guesses. And if those guesses are off, the entire financial picture could look drastically different tomorrow. For these high-stakes estimates, you have to be incredibly specific. Take an allowance for credit losses. You can't just drop a final number on the page. You have to explicitly disclose the methodology, the key inputs, and the sensitivity. For goodwill impairment, you need to detail the key assumptions in your fair value model and the sensitivity. Notice the recurring theme here? There is a heavy focus on methodology and sensitivity. The user needs to know exactly how you arrived at that number and what happens to the company if your assumptions turn out to be wrong.
But before we go writing complex sensitivity disclosures, we have to pause and ask a really fundamental question. What exactly crosses the threshold to make an estimate significant in the first place? After all, accountants are making estimates all day long. When does an everyday routine estimate graduate into a significant one that requires this intense level of deep dive disclosure?
Well, it all comes down to sensitivity. An estimate is considered significant if a change in the key assumption would cause a material change in the financial statements. If you tweak a discount rate by just 0.5% and it suddenly wipes out a massive chunk of your net income, you've got a significant estimate on your hands. It's basically a domino effect. If pushing over one small assumption knocks over the whole table, that estimate absolutely requires disclosure.
When you're drafting disclosures for these estimates, you want to follow this exact three-step blueprint. First, identify the estimate clearly by its name and the specific line item it impacts. Second, describe the methodology you used. And third, quantify the sensitivity wherever possible. Literally tell the user exactly how a 1% change in your assumption would alter the final numbers. This is what ensures users can actually rely on your estimates.
I want you to burn this next phrase into your memory. Vague or boilerplate estimate disclosures are a common audit finding. Please remember, this is not just some mindless compliance exercise where you pull up a template from last year, update the dates, and call it a day. These specific notes are some of the most rigorously read sections by sophisticated financial users. If you just copy and paste boilerplate text without providing actual specific and quantified insights into your company's unique risks, you will get flagged by your auditors. For sure.
We have covered a ton of ground today on materiality and estimates, but I want to leave you with a bit of a provocative thought. If so much of a company's reported financial health ultimately relies on highly subjective, highly sensitive estimates, just how exact is the science of accounting, really? Master this filter we talked about today, and you really master the financial narrative. In our next lesson, we are going to dive deep into subsequent events, going concern, and related party disclosures. Keep applying that filter, and thanks for joining this explainer. See you next time.